fundsupermart.com.
Hello everyone. 2014 started off on a bad note, with shockwaves spreading across various markets. Mr. Nicholas Ferres, Investment Director of Global Asset Allocation of Eastspring Investments, shares with us his views. Hi Nicholas, thanks for joining us. Last year, developed markets were the best performers overall, while the majority of emerging markets lagged far behind. Following a recent global sell-off, are equities still poised to move even higher?
We're actually neutral between developed markets and emerging markets, but within emerging markets we've been quite selective and looking at some of the cheaper markets globally. The markets that we're overweight are Korea, Brazil, Russia. We've also got some sector exposure as well in global miners, which is leveraged to China if conditions improve there a little bit. And also we're overweight gold miners. Within developed markets, we're overweight Europe, principally Italy and Spain, but we did reduce the size of that position late last year.
What do you think are the factors behind the continued volatility in the emerging markets? How should investors position their portfolio in view of the above?
I think the key factor for me is actually what's changed has been since late last year has been a rise in real rates in the United States. And that exposed some of the vulnerabilities in some of the emerging markets. Over the last few years, we've had a pretty rapid pace of credit growth in many emerging markets. In contrast to 97, it's less about a dollar mismatch in terms of debt. From my perspective, it's more of a duration mismatch. So many emerging markets are now vulnerable to a rise in real interest rates.
With the U.S. Federal Reserve officially reducing bond purchases, what is your outlook for the fixed income markets this year?
Well, in the near term, actually, the macro news flow suggests that bonds might actually do reasonably well, and we've seen a rally over the last 6 weeks or so, or a fall in yield or a rise in price, particularly at the long end of the yield curve. And actually, the yield curve steepened a little bit, so the 3 to 7 year maturities in the US yield curve have actually come down. Basically, the markets have pushed out Fed expectations a little bit further, and that's actually the precise opposite of what happened during the taper episode in the middle of, from May last year. So actually, that may be positive for bond investors and also may provide some near-term relief for emerging markets.
What is your outlook on the currency markets in the coming year, especially for emerging markets that had experienced a volatile 2013?
Yes, well, referring back to the previous question, I think the sort of moderation in the macro news flow out of the US, so the sort of moderation in the growth outlook in the near term, actually, and the fall in treasury yields, particularly at the shorter end of the yield curve, again, quite the precise opposite of what happens in the post-May last year, has actually provided some temporary relief for emerging markets. And in particular the ones that have been beaten up the most, like the Turkish lira or the South African rand, so part of the fragile five, I guess. The vulnerabilities that the emerging markets still have reassert themselves if you start to see a proper rise in the US dollar driven by more material growth out of the US, or alternatively, if we actually go into a phase of much weaker growth, that could equally be challenging for emerging markets.